If you own a business valued over $250,000 and you plan to sell within 3 to 12 months, you are in a highly sensitive window. The standard playbook suggests deciding to sell and then immediately moving to list the business through a broker. Most owners believe that when a sale falls short of expectations, it happens because the company itself lacked value or suffered from deep operational flaws. In reality, most losses occur because the owner entered the market before their financial numbers, risks, and upside were structured into a coherent narrative for buyers. Taking an unstructured asset directly to the open market is the fastest way to leak its true valuation. To understand why this leak happens, look from the buyer side of the table. Professional buyers actively search for confusion because confusion yields negotiating leverage. Look at this timeline tracking the perceived value of a business during a sale.
You see severe downward drops the moment a buyer encounters confusing financial histories, unaddressed risks, or generic claims about future growth. If you do not meticulously structure the narrative of your business before the negotiation begins, the buyer will simply invent their own story. And a buyer's internal narrative inherently prioritizes worst-case scenarios to justify a lower purchase price. Leaving the details of your business open to interpretation essentially writes a massive discount check directly to the buyer. Hidden value inherently offers zero financial leverage to you as a seller until the open market can clearly understand it. This is exactly why the Outcalt Advisory Group exists. We are not brokers, we do not list your business, and we do not sell it for you. We act as pre-market strategists. We step in before your first broker conversation to build your formal acquisition story. Structuring this narrative in advance shifts the power dynamic at the negotiating table away from the buyer, putting control back with the seller. This diagram breaks down the 6 pillars a serious buyer requires before they respect a valuation. First is the financial story. We translate past performance and complex future risk metrics into a clean, instantly digestible financial model. Next, we isolate your value drivers. This separates the inherent worth of the company from your personal history and daily involvement as the owner. Third is the upside thesis. We chart realistic, mathematically sound paths for future buyer growth. The fourth and fifth pillars package your company as a highly strategic acquisition while preemptively framing and disarming common buyer risks before they become issues. Finally, we synthesize all these elements into a broker-ready package, a pristine, unified asset ready for market distribution. Executing this 6-step armor ensures your business hits the market instantly easier to understand and mathematically harder to dismiss. Let's look at the hard economics of an asset that has achieved this comprehensive after state. Take a business with a $500,000 base valuation. If precise positioning increases perceived value by just 5 to 10%, the equation yields an additional $25,000 to $50,000 in outcome. This return stems directly from removing avoidable buyer doubt through structured preparation. This final upside completely dwarfs the initial advisory cost, turning pre-market preparation into a high-yield investment. If you own a technical, innovative, or $250,000 plus business targeting an exit within the next 3 to 12 months, your preparation window is closing. Before you initiate contact with any broker or buyer, request a confidential strategic review with Outcalt Advisory Group. Protect the financial yield of your life's work and secure your exit entirely on your own terms.